Stock prices are influenced by a complex interplay of factors reflecting the financial markets and economic conditions. Here's a concise overview. Earnings and financial performance. Positive corporate earnings and strong financial performance generally drive stock prices higher, reflecting a company's profitability. Interest rates. Changes in interest rates impact the cost of capital and influence investment decisions. Lower interest rates tend to boost stock prices. Economic indicators. Economic data such as GDP growth, employment figures, and manufacturing indices affect investor sentiment and confidence, influencing stock prices. Market sentiment. Investor perceptions, emotions, and overall market sentiment play a crucial role. Positive news and optimistic outlooks can lead to buying activity, driving stock prices up. Industry and sector trends. Performance trends in specific industries or sectors can impact stock within those categories. External factors, regulations, or technological advancements can also influence sectors. Global events. Geopolitical events, trade tensions, and global economic conditions can create uncertainties that impact stock prices. Dividends and share buybacks. Companies distributing dividends and engaging in share buybacks can attract investors seeking income and capital appreciation. Market supply and demand. Basic market forces of supply and demand play a role in stock pricing. High demand relative to supply tends to drive prices higher.